Hi everyone, it's Matt Barnes here. I'm the lead trainer at Safety in the Market. And in this video, I want to talk about why I don't trade in stocks. And the example I'm going to use today is Meta Platforms, which you may know better as its prior name, which is Facebook. And the code is FB and it trades on the NASDAQ. Now, when I talk about trading stocks, that's different to investing in stocks. Some people will invest in stocks. They'll look for stocks that they think have massive growth potential over the next 10 or 20 years, and they'll look to hold the stock that long, and they won't worry about the little ups and downs in the market, and they'll just ride the stock for 10 or 20 years. I'm not talking about that. I'm talking about people who want to trade the shorter term moves on this stock as it moves up and down and generate an income stream by doing that. Now, at first glance, Meta Platforms looks like a pretty decent stock to trade. You can see over here in July last year, the stock was trading around $340. And then a couple of weeks later, it's up just short of $380. So it's gone up by over 10% in a couple of weeks. And you might think, well, great. If I had bought there and sold a couple of weeks later, I could have made 10% profit. If you keep looking at the chart, you'll see nice strong trends up, nice strong trend down. So what's the problem, you might be asking? Well, I'll give you a clue. The problem is in the bottom right-hand corner of this chart. As you come over here, you might think that this is the end of the chart, but in actual fact, the chart data ends all the way down here with this massive gap down that occurred on the 3rd of February. Let's zoom in closer and have a better look. For those who aren't familiar with market charts, I've got a bar chart on the screen, and there are 4 key points of information on the bar chart. We have a vertical line here, and the high of that bar represents the highest price that the stock traded on this particular day, and the low represents the lowest price that shares changed hands on that day. To the left of this bar, you'll see a little dash. That's the opening price, or the first price that stocks changed hands on this day. And then to the right of the bar, you have another dash, and that's the closing price of the day. Now, the whole crux of this video, why I don't trade stocks, is that on this particular day, Facebook closed trading at around 4 p.m. at a price of $323 per share, and then opened the next morning trading at $244 per share. Traders who held this stock at the close on the 2nd of February lost about 25% of the value the very next day. Now, if you're an investor, you're holding for the long term, you might not be too worried about that. I certainly would not like to be down 25% of my account, but it's not as big of a concern. As traders, though, we're normally trading with leveraged positions. A 25% drop like that will do a lot of damage to your trading account. A best case scenario is that you're still going to lose a lot more money on this trade than you had planned on risking on the trade in the first place. And the worst case scenario is that you may not only lose all of the money in your account, but you may even end up owing your broker money. That's how bad a move like that is. Now, what causes gaps like this? Well, something has changed between the time the stock closed and the time it opened the very next day. In this case on Facebook, there was an earnings report that came out in between the market close on the 2nd and the market open on the 3rd. And based on that earnings report, which clearly disappointed the market, people were only prepared to offer $244 per share compared with the previous day's $323. Now, you might be wondering, well, wouldn't the trader have a stop loss on? And that's true. Professional traders will not trade without a stop loss. So they might buy this share. Let's say they buy it at $320 per share. They can place a sell order with their broker at, say, $310 per share and say to their broker, if the market gets to $310, please sell me out of my position because I think I'll be wrong and I want to limit my risk. And that's a very smart thing to do. The problem is, in an example like this, the market didn't trade at $310. It was $323 at the end of this day, and then the very next day it opens at $244. So when the market opens, your stop loss order is triggered, but your broker can't sell for you up here. They have to sell at the price that's available down here. So you can see how that can be a real problem for a professional trader, particularly if you're trading a leveraged position. Contrast that with a currency. This is a chart of the British pound during the COVID crash of March 2020. Look at how the market was falling apart due to bad news, and yet there are no gaps on the chart. The reason for this is that while stocks close and then reopen the next day, currency markets are open 24 hours a day. So the price can work its way down over that 24-hour day. There's no 18-hour gap where the market is closed and the price is moving. And this is why not only do I not like trading stocks, and I don't trade stocks, but this is why I like trading things like currencies or indices, because they're open 24 hours a day or very close to 24 hours a day. Now, as an instructor at Safety in the Market, whenever I tell students that I don't trade stocks, they'll often come up with a bunch of reasons for why they really want to trade stocks. And I'll go through some of them now just so that you can understand exactly why it is that I don't trade stocks. Students will say to me, well, what about limit orders? What if I place a limit order on my stop loss so that I don't get out at that $244 price? Well, let me show you how that works, and then you'll be able to see the problem with that theory. A limit order would say, sell at $310. So if the market drops to $310, sell at that price. But they might place a limit and say, well, sell if the market gets to 310, but don't sell for any less than $300. So what happens in those cases is the market comes down here, but you don't actually sell out because your limit order says, I want to sell for at least $300, which is up here. And the market never gets back up there during the day. And in fact, during the day it opens, runs up a little bit, and then keeps going down and closes even lower by the end of the day. So the problem with that is it doesn't help you at all. And at the end of the day, you're in a worse off position than you were at the start of the day. So a limit order is not going to save you. Students will then often counter with, well, what about a guaranteed stop loss order that guarantees that I get out at that particular price? A guaranteed stop loss means that you will know without a doubt the worst possible price that you will exit at before you take the trade. And you can build your risk around that. Now, at first glance, that seems like a pretty good deal, but there are two problems with guaranteed stop loss orders. The first one is that they are a little bit more expensive, so you're going to be paying a premium for your guaranteed stop loss orders. Now, when it comes to facing a huge gap like we saw on Facebook, or paying a little bit more for a guaranteed stop order, of course you'll go for the guaranteed stop loss order. But the point I want to make there is you don't need to use a guaranteed stop loss order on other markets like currencies or indices. When it comes to trading, you want everything possible to be in your favor. And if you can trade two different markets and on one of them you need to use guaranteed stop loss orders and the other you don't, well, you would pick the one where you don't need to use the guaranteed stop loss orders. The second challenge that I see with guaranteed stop loss orders is that they have to be placed a fair way away from the market. So if I want to place a stop loss, I might only want to have that stop loss 10 cents away, but the broker might say, no, you must have it 20 or 30 or 40 or 50 cents away. So you've got to place that further away because that's how the broker wants to operate these. Now you might say, well, what's the big deal? You just have your stop loss a little bit further back. Well, the problem there is that it significantly reduces your reward to risk ratio. For me, the reward to risk ratio is what separates professional, profitable traders from amateur traders. The reward to risk ratio is basically making sure that when you're right on a trade, you make a lot more money than you lose if you're wrong on the trade. So let's look at an example. Let's assume that you're taking a trade and you want to risk 10 cents for every share that you take. So if you buy one share and you're wrong, you're going to lose 10 cents per share. We'll ignore brokerage for now. If you want to trade 1,000 shares, you're going to risk $100 on the trade, etc., etc. If you are right on the trade, and let's say that you look for a $1 reward per share, your reward to risk ratio of $1 per share is going to be a 10-to-1 reward to risk ratio. Now, I believe a 10-to-1 reward to risk ratio is the minimum that you should look for when you're getting into a trade. And in fact, just as I was preparing this presentation, I received an email from one of our students, Tom, who had just made his first big reward to risk ratio trade. He'd taken 17-to-1 reward to risk out of a trade on the Australian dollar. Now, with a reward to risk ratio, whether you're risking $1,000 for every trade or just $50 on the trade or just $5 on the trade, making 17 times what you're risking is a fantastic result. However, if you look at this calculation, you can see that In order to increase the reward to risk ratio, you either need to reduce your risk or increase your reward. And it's not always possible to increase the reward on the trade because markets can only move so far. So in that case, a big determinant of your reward to risk ratio is going to be your risk. Now, if you take that same trade, but you have to put your stop loss further away, and we'll say 20 cents per share in this case, but with guaranteed stop losses, sometimes they have to be a fair way away. But if you take that same trade and your risk is now 20 cents per share, and you can still only make $1 on the trade, well, all of a sudden your reward to risk ratio is only going to be 5 to 1. So the guaranteed stop loss, yes, it can protect you a little bit, but it's going to significantly eat into your reward to risk ratio. Now, as a trader, let me ask you this. If you have a choice of trading two similar markets, but in one of them, you have the risk of gaps and you have to use guaranteed stop loss orders, which cost more and have to be further away, which mean that you're risking more and your reward to risk ratio is lower, so you're getting less bang for your buck. Or you can trade another market where it's open 24 hours a day, you're not likely to have gaps, you don't need the guaranteed stop loss, so your reward to risk ratio is going to be larger. Why would you trade one when you can trade the other? Why wouldn't you go for the market where you don't need the guaranteed stop loss order? Another thing, students who want to trade stocks, and it's funny how sometimes people can be so determined that they want to trade stocks. I understand what that's like. When I was just starting out as a trader, stocks were all that I knew, all that I understood. And the thought of trading a currency was, oh man, what are all these numbers? I don't understand what am I buying or selling? How do I work it? I was very confused. So I get that. But if you check out our FX trading series on the Safety in the Market YouTube channel, you'll see that trading currencies is actually fairly straightforward once you know what you're doing. And once you know what you're doing, you'll probably never go back to trading stocks after trading currencies. But people who still want to trade stocks will say, well, what if I just avoid trading around earnings dates? So these dates where earnings are coming out, we know in advance that those earnings are going to be announced. We can steer clear of the market. And again, that does make a little bit of sense, but think about this. Significant news can come out at times other than earnings dates. So there might be an accounting scandal that pops up or an investigation that's underway in that market, and that's not going to be announced beforehand. So you may see a gap anyway, or there may be a major geopolitical event. There might be a war or an invasion or a pandemic or any kind of announcement like that could come out and could occur while your market is closed. So it's not just earnings dates where we can see gaps. Now, even after having all of these discussions, students will still say to me, but Matt, I want to trade stocks. And my answer to them will be, that's fine. You're allowed to trade stocks. You see, in trading, one of the biggest benefits that we have as professional traders is we don't have a boss telling us what we can and can't do. However, one of the biggest cons of trading is that we don't have a boss telling us what we can and can't do. So we have to learn and we have to make these decisions for ourselves. Now, I tell people why I don't trade stocks, and I leave it at that. If they want to argue any further, I say, okay, that's your personal decision, and you can trade stocks if you like. As I said earlier, though, as traders, you want as much in your favor as possible, because at the end of the day, it's your money that's on the line, so why not give yourself every advantage possible? But for those who are still not convinced, let me give you a case study. This is a stock called Commonwealth Bank. It's one of the big four banks here in Australia, and the code is CBA, and it trades on the Australian Stock Exchange, or the ASX. It made a top in November of 2021, and as you can see, it fell quite heavily from there. Now, if you glance across Commonwealth Bank, you'll see a few times where the market gaps up, probably on good news that's happened overnight, and you'll see a few occasions where the market gaps down. Now, those gaps down, some of them will be predictable because they are what's called ex-dividend dates. And that's where if you're holding the share on this date, the next day a dividend is paid and you're going to receive that. But the day after, if you're holding those shares, you don't get that dividend. So if the dividend is perhaps $1 per share, the price will normally fall by $1 per share the next day in order to adjust for the fact that this person who buys today gets the dividend, this person doesn't. Okay, so those gaps are predictable. You can see them coming. This large gap down, however, that was not based on earnings or dividends. It was an announcement that came out there and the market fell quite heavily from there. Now, if you had picked the top and you're trading to the downside, a gap in your favor means you're going to make money very quickly. And sometimes people get carried away with that. They say, oh yeah, I'm going to be really good. I'm never going to get it wrong in the market and I'll be on top of these gaps. I'll only trade the right way and I'll make money off gaps. And you will make some money off gaps like this and you'll feel really good. But go back to that Facebook or that Meta example from earlier. It only takes one bad gap against you to wipe out a large chunk of your trading account or perhaps all of your trading account, and then you're finished as a trader, at least for now. And from my point of view, that should never, ever happen. And if you trade currencies and indices, it's not going to happen. But if you trade stocks, there is a chance in your trading career that it will happen to you at some point. Now, that's a November top on Commonwealth Bank. It was callable in advance. And in fact, it's a market that we did look at in our active trader program coaching. Similar to that, there was a top on the NASDAQ, also in November of 2021. For those of you who have Profit Source software, you can open a chart of this E-mini futures contract on the NASDAQ by looking up EN-spot V in your software. But here you can see the market made a top and it had a very heavy fall to the downside, but there are no gaps in there. Okay, let me go back to Commonwealth Bank for a moment. Same sort of fall, a big crash, but that huge gap there and a little minor gap over here. Looking at the NASDAQ, there's no gap. So if you get it right on each of those trades, you're going to make similar sorts of money. If you get it wrong and the market moves heavily against you, there's a much bigger chance of you getting hurt badly on a stock than there is on a currency or an index. Here, if we're wrong, we have a stop loss in place. It doesn't even need to be a guaranteed stop loss, just a normal stop loss. We get stopped out pretty much where we wanted to be stopped out if we were wrong. And that's it, we move on to the next trade. So just comparing those two examples, both markets made tops in November of 2021. It's not like one of those tops happened during a very volatile period and one happened during a very quiet period. Both made tops in the same market conditions. Both tops were knowable in advance, and both tops were called using the exact same techniques from our active trader program online training. In fact, the NASDAQ top that occurred, we had been looking at that price level, that 16,700 price level, for 6 months before it happened. Now, if there was some great technical advantage that only applied to stocks and didn't apply to indices or currencies, okay, maybe fair enough, you could trade stocks instead of those other markets. But the fact is, the same techniques work just the same on both Commonwealth Bank, a stock, and the NASDAQ, which is an index. It's the same technique that called the S&P 500 top in February of 2020, just before the COVID crash. And it's the same technique going back to the 1980s when David Bowden called the 1987 top and called the 1989 top a year before it happened. The difference is that Commonwealth Bank trades from around 10 a.m. to 4 p.m. every day, Sydney time, whereas the NASDAQ futures trade almost 24 hours a day. So if bad news comes out for either of those markets, if it comes out between 10 and 4 p.m. on a trading day for Commonwealth Bank, well, you're probably going to be okay. You're not going to get gapped against too badly. But if it comes out overnight, for example, the next day you're going to get that gap open. Whereas if you're trading NASDAQ futures, the news will come out and then you'll get stopped out if you're wrong. And that's it. That's the end of the trade. So if you think about all of that, if you've got the same techniques at your disposal and they're equally powerful, they can call the top of the Commonwealth Bank, they can call the top of the NASDAQ. There's no advantage in trading one or the other. Why wouldn't you pick a market like an index, like the NASDAQ or the S&P or the SPY 200 here in Australia, or a currency like the Australian dollar or the British pound or the Canadian dollar, which is open 24 hours a day? You know, it just doesn't make sense to me to trade stocks. Anyway, that's why I don't trade stocks. It's up to you as a trader to decide what kind of market you'd like to trade. And for those of you who'd like to learn exactly how those tops on Commonwealth Bank and the NASDAQ were predicted before they happened, you can check out our active trader program online training by clicking on the link in the description to this video. That's all for today. If you enjoyed the video, please click on the like button and also be sure to subscribe to the channel to keep up to date with all of our upcoming videos. Thank you for watching, and I will see you in the next video. Bye for now.